Good day. Ira Epstein of Linn & Associates with your afternoon SPDR ETF video for this March 5th, 2020 at about 4:47 p.m. Central Time. So let me tell you where we're back to. And, I hate when this happens. We're dealing with this coronavirus situation. It's put pressure on interest rates, which in turn is putting pressure on the stock market. You got under 0.9 today in the 10-year notes. Unbelievable action going on there. We don't know how many cases are about to be announced. Remember, there's 400,000 kits going out now to the different states for the testing. Next week, there'll be 1.5 million. You know, when you have that many kits and that many people being tested, you're going to find more cases. So it'll be more cases, not necessarily more mortality, but it's like a mini panic is happening in different areas. The state of California declared a state of emergency. Seattle's got lockdown areas. I mean, it's not the best situation. And of course, you hear about Italy, what's going on there. The schools are closed. Japan's schools are closed. So this gets serious. And it weighs on different sectors, and it weighs on the stock markets themselves. I did a special report today, so if you go to our website and you go to our research area under the special reports, you'll see that I did one on the stock indices and the SPDRs and ETFs primarily. Actually, it was more ETFs than the stock indices, using one study, Fibonacci, showing you where the retracements had come in and what's going on. We'll talk about that at the end of this, but you can go to our website to view it. So, your gold was up, your GDX up again today, silver, TLT, the safe havens up, the dollar down as these markets up, and of course, when you look at everything else, a sea of red that you're in. So we get to the different parts within the market, and you can see you've had this nice bounce, and now the question is, what next? Now we know that Fridays with this virus have been difficult to say the least. And the reason is you don't know when you come in on Monday morning because the futures markets open Sunday night. What are you walking into? And that is the dilemma traders are facing. If we look at this pattern, we had a bounce in a market that has now got a pattern of lower highs. It certainly has the lower lows. So one of the numbers that if you were more inclined to be friendly that you'd want to see taken out is this 94.66. Why? That could give you a pattern of higher lows and higher highs. If you're bearish, what number don't you want to see taken out? 94.66. The reason is, when we look at moving averages and the like, the battleground is the 100-day average. This market made a test of its 200-day moving average of closes. Technicians look at the 200-day average. If the market just slices through it, then it's resistance on the way up. If it holds it, they say, it held the 200-day average. It's almost a one-year average, and they consider that, if you think about it, well, that's good. On the way back, I looked to see where other key moving averages are. So the resistance, you went back through the 100-day, but now we're playing almost at it every day. You're under the 18-day average, trying to hold the 100. If that gives ground, then the 200, a secondary test of it, could be what the market wants to do. In terms of Bollinger Bands, that's these black dashed lines here and here, they keep widening out. And the reason that they're fanning out is the volatility is so large. Normally they come in, they wrap their arm around a market when you don't have a lot of volatility, or they'll stay in a trend where the market finds the resistance at that number in a trending market. You're in anything but a trending market. You're in a whipsaw market that I think has downside bias to it, a trend down for the moment. The question is, can it go back down and challenge those lows? We've had enough of a bounce in the market to not be oversold. My definition of oversold is when the slow stochastic readings, either of the red or the blue, they're called the K and D line, if they're under 30. They both have recovered enough to not be there. So we are at an important juncture in the market. I'll repeat, I don't want to see 94.66 taken out if I were bearish. I want to take it out if I'm bullish, and then I would love to see a close if I'm bullish over this 96.50 level, barring that with the trend down, the bias down. Who's got control of the market? The bears for the moment. In the industrial sector, you've had a pattern of lower highs, lower lows. this is one of those cases you can't even get back to that 200-day average yet. Now, if the market were to rally over this week's high so far, tomorrow, I could make an argument. Maybe you're going to make higher lows, higher highs, and try to get into all this resistance of the 100-day average, the 100, and the 200. But who's controlling of the market? The market's right now controlled by the bears. It is oversold. If you drop from here, the question is, will the market find support at the lower Bollinger Band? If you rally, I see an awful lot of resistance stopping all of a sudden an uptrend from developing. And it's the same in the energy sector. You know, in the energy sector tomorrow, what you're walking into is, what does OPEC do? OPEC on its own might go ahead and cut 1.5 million barrels additional. That's almost 3.6 million barrels a day if they go to their 2.1 that they had cut, and if Russia stays in the deal or if Russia joins in the deal. If Russia doesn't join in with OPEC, does OPEC still cut that 1.5 million knowing that Russia is going to pick up the market share possibly that they're giving up? It's a real wild guess. Remember the time differences. They're meeting, I believe it's in Vienna. Take it all into account. It's going to be a crazy day tomorrow in the energies, but right now the bears are in control. They have lower highs, lower lows on the market. Next support is under the most recent break low. So I've heard talk today of people thinking it could be a $5 move in this market over the next no time, depending on which way this thing goes. QQQ. Battleground, 100-day average of closes. You've got lower highs, lower lows. You had that one stab where the market got down to the 200-day and gave you a bounce, and now you're in the stall. This market's not down as much as people think in the NASDAQ for the year. It's down like 2.5%, 3% because the market bounced back. Remember that. I think the biggest index is down like 7.5% this year. But you've got to be careful here. Again, this is a market that's full of what? Panic. So let's look at both sides. If you don't take out 219.61 and you drop the Bollinger Band to the 200-day average is the support zone. If you take out 219.61, you break this level of the downtrend, you make a case to get back to the 18-day average. The Fibonacci numbers are all in the point where you've broken down, you rallied about 50% in the NASDAQ, the Dow, and the S&P, and you're failing again from that level. You only got up to about a 1/3 retracement off the lows in the Russell. When you look at the emerging markets, they're still in bear territory, still coming down. The question is on the emerging markets, if the rest of the world's coming down, did they already have the worst case scenario happen to them? That's something we have to take into consideration. And I say it because we're not hearing that many bad cases of the virus anymore out of China. It's more out of South Korea, it's Japan, it's Europe, it's certainly our country. We'll see what goes on in the next step. In the gold market, the resistance is the upper Bollinger Band, this black line. Why? 95% of the time the market will trade within the bands. So when you step back to, let's call it that line in the sand, that 18-day average, it's like a pinball machine. Everything activates again. You had been on tilt, you went back down, the machine lit up. That's a resistance point. The trend up, resistance point. What about now in the gold miners? Well, the gold miners are acting better than I was giving them credit for. The market been fighting for 2 days against the 18-day average, the red line. Today the market opened, and if you take a look, 28.96 is the low. That 18-day average is 28.95. It was able to extend the gain. So I am back into the bull camp again because now I have patterns that are higher lows, higher highs. What breaks the pattern? Taking out 28.28, this last break low of yesterday. Barring that, where's the upside target? Upper Bollinger Band. Who's got control? The bulls going home. You're over the 18-day average, bias up, momentum up, trend up on the swing line. TLT, just running to the upside as people, they're really concerned about a world recession off of this epidemic. I don't know why it's not called a pandemic yet, but whatever WHO says it is, it is. Now, yesterday we had a false reading. You lost the embedded reading, which is often a prelude to price coming down. And only time you can regain it is the very next business day, and it's got to do it right away. It did. When it reopened, it stayed strong. So it's a sign, and this is how I take it, of the market wanting to react back to the downside, but it's staying up and it's just staying on that Bollinger Band, not really running from it. In the euro currency, as the dollar keeps breaking, in large part because of where we're at with the disease that's spreading, the virus, where we're at with interest rates falling, and our economy very susceptible to a shock right here. I'm not saying Europe isn't, they're already in the shock, but people are buying this euro currency and it's staying strong. It's got higher lows, higher highs. Now, it has cleared the 200-day average, but it's staying locked in on that upper Bollinger Band number in an overbought condition. Very high-risk trading. In the oil and gas exploration, who wants any part of it other than Sam Zell? But he's not in the oil exploration. I don't know if you saw him today. I think it was on CNBC. And he was very, very clear about what he's doing. He is buying companies at distressed levels that have proven wells that are drilled. He thinks it's gift time. I've ridden motorcycles with him. We live in Chicago. I've gone on, not his trips. The man's very famous for the trips, but I've ridden around the city, restaurants with him on my bike. And very interesting man, very bright. And he sees something. It's that simple. And his horizon isn't tomorrow. He's got a longer-term horizon. You're still down, though, in the oil exploration into a bear position. So when you put it all together, you try to figure out where do you go. And that's why I did a special report on the stock indices. And rather than a lengthy one, this one's rather short. It's about 5 minutes long. It's a video. And it just goes through the Fibonacci retracement, because that's what I think the market is looking at. Tie yourself into Fox, Bloomberg, CNBC. We're all looking at the same thing now. We're trying to figure out the bounce we had. Is that the sign that the market got ahead of itself on the downside? Or did the bounce give you energy to come back down, challenge those lows? And if you take them out, what next? In order to get to the report, just go to our website. Under the word research, you'll see the special report there. Click on it, and away you go. I'm Ira Epstein. Thanks for watching, and I'll see you tomorrow.